Imagine a company whose entire future hinges on a single, imminent scientific result. A true high-stakes gamble with the potential to revolutionize medicine or, well, fall short. Today, we're taking a deep dive into just such a company. aTyr Pharma, ticker symbol NASDAQ. AT. Well, welcome to the deep dive. We take your sources, pull out the key insights, and give you a shortcut to being well-informed.
Yeah, so for this deep dive, we're focusing on aTyr Pharma as of July 28th, 2025. Share price was $5.83 just a few days back, July 25th. Our mission today is really to dissect its science, its strategy, the management team, financial health, and crucially, the risks, all leading up to this pivotal moment.
Exactly. This isn't just about numbers on a screen. It's about understanding the core of a company right at a crossroads. We'll uncover some surprising facts and critical insights. So let's jump right in. Chapter 1. The business of aTyr Pharma, a bet on novel biology. Okay, so the core challenge for aTyr Pharma right now, it's crystal clear. They are at a truly pivotal juncture. Top-line phase 3 data for their main drug candidate, Efzofitimod, is expected anytime now, third quarter of 2025. So the question for you, the listener, is simple. Is this company about to hit a home run in rare inflammatory diseases, or will it, strike out like so many biotechs before? The outcome of this single trial, it's likely going to set their course for the next decade.
All right, and what's interesting is how they operate. It's the classic clinical stage biotech playbook. They essentially burn through capital, right? Funding multi-year R&D, these big clinical trials. There's no real product revenue coming in yet. So their finances are all about that cash consumption or burn rate. Any future money depends completely on getting these trials right, getting regulatory approval. Either they sell it themselves or through deals like the one they have with Kyorin Pharmaceutical for Japan.
Let's talk about that lead candidate, Efzofitimod, or aTyr 1923. It's their crown jewel. What makes it tick? What's the novel part?
Okay, so it's a biologic immunomodulator. It targets a protein called neuropilin-2, or NRP2. NRP2 is pretty key in inflammatory pathways. The idea here is to dial down the immune response without just shutting everything down, avoiding broad immunosuppression. That's why they're calling it potentially first in class, its main target. A group of conditions called interstitial lung diseases, ILDs, specifically one called pulmonary sarcoidosis.
Okay, so that brings us to the trials. What are the specific studies leading up to this make-or-break moment?
Well, the main event is the phase 3 Efzofitimod study. That's the one in pulmonary sarcoidosis. They finished enrolling all 268 patients. And the big news recently, July 22nd, was the last patient, last visit. That means the data readout is definitely on track for this quarter, Q3. The goal: to help patients cut back on oral corticosteroids. Those are the standard treatment now, but they have some really nasty side effects. Then there's the phase 2 Efzofitimod study. That's looking beyond sarcoidosis into systemic sclerosis-related ILD. They had positive interim results back in June, showing some clinically meaningful improvements. That's a good sign it might work in other related diseases too.
And while Efzofitimod is clearly the main story, they do have other things cooking in the background, right? Like aTyr 2810 for cancer.
Yeah, they have a preclinical pipeline. aTyr 2810 is one example, targeting aggressive cancers. It shows the breadth of their underlying science, this tRNA synthetase biology platform. But let's be clear, Efzofitimod has to work. Its success is the crucial validation needed for this entire scientific approach. If it fails, it casts a shadow over everything else.
So putting this in perspective, aTyr is, well, it's a small fish in a big pond, right? Market cap around $519 million, just 49 employees.
Relatively small, yes. But their scale right now isn't measured in sales, it's measured in clinical execution. That global phase 3 trial, Efzofitimod, ran in 85 centers across 9 countries. That shows they can handle complex, large-scale operations, which is impressive for their size. And that Kyorin partnership you mentioned earlier, it's potentially worth $175 million in milestones. That's external validation. Plus, it gives them a way into the Japanese market without spending their own cash. Very capital efficient.
And the core appeal, the value proposition, it comes down to filling a gap, doesn't it? A big unmet need.
Absolutely. For pulmonary sarcoidosis specifically, there hasn't been a new FDA-approved treatment in over 70 years. Think about that. Patients are stuck with corticosteroids and their side effects. If Efzofitimod works and is steroid-sparing, that's a fundamental change in how this disease is treated. That resonates hugely with patients, doctors, and the people who pay for healthcare.
Okay, so how big is this market they're aiming for? You mentioned ILDs.
The overall interstitial lung disease market is substantial. We're talking around $1.9 to $2 billion this year, 2024. And is projected to grow quite nicely, maybe reaching nearly $2.9 billion by 2029 or 2031. That's like a 6.5% to nearly 8% compound annual growth rate. Growth is driven by more diagnoses, better awareness, and new therapies coming online. North America is the biggest piece of the pie. Even just the pulmonary sarcoidosis slice is expected to grow strongly. Some really optimistic forecasts see it hitting, well, massive numbers like $47 billion by 2032, although that seems quite high. Still, significant potential.
And competition. Who else is playing in this space?
You've got the established players with antifibrotic drugs like Boehringer Ingelheim with Osev and Roche with Esbriet. They're the benchmarks. But those drugs have their own issues, challenging side effects. Other companies are in the running too, like Kinevant Sciences, Novartis. They have programs in development. Efzofitimod's edge, or potential edge, is its different mechanism, the NRP2 targeting, and that hope for a better safety profile, plus the steroid-sparing angle. That's how they plan to stand out.
So in this tough, risky field, how do they protect themselves? What are the barriers?
Well, they've managed to secure some critical regulatory advantages. They have orphan drug designation in the US, EU, and Japan for sarcoidosis, and also for systemic sclerosis in the US and EU. That gives them things like tax credits, but more importantly, years of market exclusivity if they get approved, usually 7 to 10 years. That's huge. Plus, they have fast-track designation in the U.S. for both conditions. That means the FDA review process could be quicker. It's a key strategic plus. Beyond that, the barriers are just inherent to biotech. You need deep scientific knowledge, massive amounts of cash for trials, which are super risky. You have to navigate complex regulations. And then there's the cost of manufacturing and selling. It's not an easy business to just jump into.
Okay, so for a company like this, without sales, what constitutes their competitive advantage, their moat, so to speak?
Yeah, good question. For a clinical stage company, it's all about intangible assets. They don't really have brand recognition yet, but a positive phase 3. That would instantly create a powerful brand around Efzofitimod. There are no cost advantages or economies of scale right now. They're just spending money. But post-approval, if the drug really is better, you could see switching costs develop, where doctors and patients prefer it. Their real unique assets, their moat, is built on that proprietary science platform. The tRNA synthetase biology, the first-in-class NRP2 mechanism, and those regulatory wins like orphan drug and fast track, plus their patents. That's the foundation.
Chapter 2, Management Evaluation. All right, let's shift gears and talk about the people steering the ship. In biotech, maybe more than any other sector, management quality is just critical, especially with so much riding on this one event.
Absolutely. And the leadership team here looks, well, pretty well suited for the challenge. You've got Sanjay Shukla, the CEO. He's been leading since 2017, got Efzofitimod this far. His background is interesting. He was a VP at Novartis, Global Head of Integrated Medical Services. That means serious experience running big global clinical trials, exactly what you need. And there's Jill Broadfoot, the CFO, on board since 2018. Her experience includes being CFO at other biotechs, but importantly, she was VP and U.S. Corporate Controller at GW Pharmaceuticals. She helped build their commercial operations for a major product launch there. That's precisely the kind of experience aTyr will need if Efzofitimod gets the green light.
And it's worth pointing out, they've successfully navigated that really tough period, the valley of death, getting the funding needed to reach this late stage. That's not easy.
No, it's definitely not. Securing the capital to get to phase 3 complete is a major accomplishment in itself. Shows good strategic planning. In terms of transparency, they seem standard. Regular press releases on milestones like finishing enrollment, positive safety reviews from the Data Safety Monitoring Board, that last patient visit announcement. They publish in scientific journals, engage with researchers, file regularly with the SEC. Our sources don't flag any major red flags, ethical issues, or lack of transparency.
So for a company like aTyr, pre-revenue, capital allocation is pretty straightforward, right? It's not about dividends or buying back stock.
Exactly. It's all about feeding the pipeline. Their strategy is laser-focused. In the first quarter of this year, R&D spend was almost $12 million, mostly for the two big Efzofitimod studies, Efzofit and EsoConnecta, and their business development efforts, focused on smart partnerships like the Curin deal. It brings in non-dilutive funding potentially, shares the risk, gets them into key markets without having to build everything themselves, preserves capital.
Right, so no share buybacks, no dividends, standard for this stage. All the money goes back into the research.
Correct. Every dollar is basically reinvested into advancing the science in the clinical programs.
What about return on invested capital, ROIC? I imagine that number looks pretty grim right now.
Grim is one way to put it. It's deeply negative, around minus 72%.
Oh.
But, and this is crucial, that's not a sign of poor management or bad decisions here. It's just the nature of the beast for a pre-revenue biotech burning cash on R&D. The whole investment idea isn't about the ROIC today. It's a bet on the potential future ROIC if Efzofitimod gets approved and launched. Rare disease drugs, especially first-in-class ones, can have very high margins. If it's successful, that ROIC could flip dramatically positive down the road.
Chapter 3. Financial analysis. Okay, let's dig into the numbers. Now, we've already established that for a company like aTyr, traditional financial metrics can be, well, misleading. So what do the financials tell us?
Right, context is everything here. Let's look at the key metrics. Market cap, around $519 million. That number basically reflects the market's guess about the future value of their pipeline, but heavily discounted because of the risk involved.
Right.
Revenue trends, it's a pre-revenue company. Historically, nothing significant. The whole bet is on a massive jump in revenue after potential approval. Analysts are throwing out numbers like over $500 million by 2029, maybe starting late 2026. Profit margins, all deeply negative. Not really meaningful right now because there's no top-line revenue to speak of, just R&D costs. Trailing 12 months net loss per share was about negative 0 to 80 cents. Free cash flow, consistently negative. That's the cash burn we talked about. Over the last year, they burned through about $37 million funding research and trials.
But despite burning cash, their financial stability seems to be a key point. They look surprisingly solid heading into this data readout.
They really do. While the income statement shows consistent losses, which you expect, the balance sheet looks strong. Their debt-to-equity ratio is very low, very conservative, around 0.17, minimal debt. They mostly fund themselves by selling stock, avoiding big loan payments, and the current ratio is exceptionally strong, almost 7.8. That means they have nearly 8 times the liquid assets needed to cover their short-term bills. This strong cash position comes from successful fundraising before they hit a potential crisis. It gives them a really significant cushion. In fact, the company specifically says they have enough cash to operate for a full year after they get the phase 3 results. That's huge flexibility.
So that balance sheet paints a picture of really strategic financial management, building up that war chest ahead of time. Smart. But then how on earth do you value a company like this if PE ratios and things are useless?
Yeah, that's the million-dollar question, or maybe the half-billion-dollar question in this case. Traditional metrics are out. The most appropriate method, really the standard for clinical stage biotech, is risk-adjusted discounted cash flow analysis, or RNPV.
Okay, break that down for us. RNPV.
Basically, you try to forecast future drug sales if it gets approved. Then you project all the costs, manufacturing, marketing, R&D for other things. Calculate the free cash flow from that. Then comes the crucial step. You risk adjust those future cash flows. You multiply them by the estimated probability that the drug will actually succeed in trials and get approved. That probability is obviously less than 100%. Finally, you take those risk-adjusted future cash flows and discount them back to what they're worth today, using a discount rate. Analysts, as we said, are projecting really aggressive growth, starting from maybe $28 million in 2026, ramping up fast to over $500 million by 2029.
Wow, that's a steep climb. What are the key assumptions you'd need to believe for a model like that?
Well, the growth rate assumption is key. Zero revenue until maybe late 2026, early 2027. Then an absolutely explosive ramp up, maybe over 150% CAGR initially. It would eventually slow down as you get closer to the patent cliff, when generics can enter. And the discount rate assumption is also critical. For a high-risk company like this, you need to use a much higher discount rate than for, say, a stable blue-chip company. Think 13%, 14%, maybe even 15% or higher. That reflects the uncertainty, the high cost of their equity capital. If you build a DCF model using those analyst projections, even with a high discount rate, the resulting valuation, the RNPV, often comes out significantly higher than the current stock price. So if you're investing now, you're implicitly saying you believe those aggressive growth forecasts are achievable if the trial works. You're betting on that binary outcome.
Chapter 4. Market sentiment. Okay, we've looked at the science, the management, the financials, but what does the market actually think? How is Wall Street handicapping this big bet? This is where it gets really interesting.
It really is. The market perception, at least from the analysts covering the stock, is overwhelmingly bullish. The consensus is basically buy or strong buy across the board. Some sources show 0 analysts recommending hold or sell. And the price targets. The average one-year target seems to be hovering around $19.35 to $20.20. That implies, what, over 230% potential upside from where it is now. Now, the range of those targets is huge, from $9 all the way up to nearly $37. That wide range screams high uncertainty, but even the low end suggests significant upside if the phase 3 data hits.
And we saw how sensitive the stock is. That huge jump, 26% on July 23rd, just from announcing the last patient visit was done. That really fanned the M&A flames too. Plus, getting added to the Russell indexes back in June probably helped bring in more institutional money. The whole narrative is just intense anticipation for this Q3 data.
Intense anticipation, exactly. But then you look at another key market indicator, and it tells a completely different story. Short interest. It's staggeringly high. As of late June, about 18.5 million shares were sold short. That represents over 21% of the publicly available shares, the float. That is an exceptionally high level of short interest. It means a large, presumably sophisticated group of investors is actively betting the stock price will go down. The days to cover ratio is about 4.4. That means, based on average trading volume, it would take shorts over 4 days to buy back all those shares if they needed to cover.
So you've got this complete barbell dynamic, extreme bulls on one side, the analysts, and extreme bears on the other, the short sellers. The current stock price, $5.83, is basically the market trying to balance those two wildly different potential outcomes.
Precisely. It's a tug of war. And this sets up the potential for a massive short squeeze. If that phase 3 data comes out positive, all those 18.5 million shares that were shorted have to be bought back in the open market. That sudden surge in demand could cause the price to just explode upwards very rapidly. Looking at momentum, the stock is showing strength leading into this. At $5.83, it's trading well over 17% above its 50-day moving average. And even more impressively, it's over 55% above its 200-day moving average. That confirms a really powerful long-term uptrend, likely reflecting that market anticipation despite the shorts.
Chapter 5. Ownership structure. Let's talk about who actually owns aTyr. Does the ownership structure give us any clues?
It does offer some insight. Institutional ownership is very high. Around 75% of the shares are held by institutions, mutual funds, hedge funds, pension funds. That tells you it's definitely on the radar of sophisticated professional investors. The top holders are big names. Federated Hermes holds a significant chunk, around 16–17%. Then FMR LLC, which is Fidelity, holds about 14–14.5%. BlackRock, 0.72, Vanguard, they're all in there with substantial positions. Having these kinds of well-respected firms involved adds a layer of credibility.
Okay, that's the institutions. What about the insiders? The executives, the directors, are they putting their own money where their mouth is?
Direct insider ownership, as a percentage, is relatively low, just about 2.3%. However, what's more revealing are the recent insider transactions. Over the last 12 months, we've seen some notable open market purchases by insiders and, perhaps more importantly, a lack of significant selling. For example, Director Paul Schimmel bought shares multiple times back in July 2024 when the price was much lower, around $1.74 to $1.93. And more recently, Director Jen Gross bought shares in March 2025 at $4. Overall, insiders have bought a net total of over 53,000 shares. That's a pretty strong signal, a vote of confidence from the people who know the company best. They're buying, not selling, ahead of this major data release.
So with institutions holding so much and insiders buying, what does this concentration mean for you, the individual investor, thinking about this?
Well, the ownership is highly concentrated. The top 8 institutions own over half the company, 51%. The top 25 own over 71%. On one hand, that means the decisions of just a few large funds can really move the stock price, adding volatility. But on the other hand, it suggests that a core group of large, presumably well-researched, high-conviction investors controls the majority of the shares. They're likely in it for the long haul, waiting for this catalyst.
Chapter 6. Risk assessment. All right, every opportunity carries risk, and with aTyr, the risks seem particularly stark. Let's do a formal SWOT analysis. Strengths, weaknesses, opportunities, threats.
Okay, let's break it down, starting with strength. They've got that novel scientific platform, the tRNA synthetase biology. They have a late-stage lead asset, Efzofitimod, with this huge near-term catalyst coming up in Q3. They've got positive regulatory momentum, orphan drug, fast track. The management team has a relevant big pharma experience. And crucially, they have a strong balance sheet, enough cash for a year post-data.
Okay, sounds good. What about the flip side, weaknesses?
The biggest weakness is the single product dependency. If Efzofitimod fails, it's almost certainly catastrophic for the company's current valuation and trajectory. As an organization, they lack commercial experience. They haven't launched a drug before. The cash burn rate, while managed, is still high. And while the recent insider buying is positive, that overall low percentage of insider ownership could be seen as a slight negative by some.
Now for the exciting part, opportunities. What's the potential upside beyond just getting this one drug approved?
Well, the immediate opportunity is addressing that huge unmet need in pulmonary sarcoidosis, remember. No new treatments in 70+ years. That alone is significant. Then there's the potential for market expansion. If Efzofitimod works in sarcoidosis and the phase 2 data holds up, it could potentially be used in other ILDs too, a sort of pipeline in a pill. Success would also validate their entire scientific platform, which could unlock value in their earlier stage pipeline, like that cancer drug aTyr 2810. And finally, if they get positive data, they could become a very attractive M&A target for a larger pharmaceutical company looking to buy innovation.
Okay, and now the big one, the threats, especially the threat.
Right. The threats, let's be direct. Clinical trial failure. This is, without a doubt, the single greatest and most immediate threat. Phase 3 trials have a high failure rate across the industry. A negative, or even just ambiguous or inconclusive result for the Efzofitimod study would likely cause the stock price to collapse dramatically. It's the elephant in the room. Even if the data looks positive, there's regulatory rejection risk. The FDA or other agencies might find safety issues or demand more trials, delaying or preventing approval. There's intense competition. The ILD space has big, established players like Roche and Boehringer Ingelheim, plus other biotechs racing to develop new treatments. Financing and market risk is always there for biotechs. If there are delays or if the broader stock market turns sour, raising more money in the future could become difficult or very dilutive to existing shareholders. And even with approval, there's market adoption and reimbursement risk. Getting doctors to prescribe it and insurance companies to pay for it isn't guaranteed.
Those are the company-specific threats. What about bigger picture macroeconomic stuff?
Yeah, those matter too. Inflation is a threat because it increases their cash burn, trials cost more, supplies cost more, salaries go up. And unlike other businesses, they can't just raise prices because they don't have a product yet. Interest rates hit biotech particularly hard. Higher rates mean the discount rate used in those valuation models goes up, which lowers the calculated present value. It also makes borrowing money or raising capital more expensive. It basically acts as a risk multiplier. And you could even imagine geopolitical factors, say hypothetical new U.S. tariffs, maybe 10% baseline, maybe more on goods from certain countries. If a payer sources key components for manufacturing Efzofitimod internationally, tariffs could suddenly increase their costs, squeeze margins, and add supply chain headaches.
Chapter 7, Conclusion. Okay, we've covered a lot of ground, the science, the team, the money, the market, the risks. So let's bring it all together. What's the bottom line for you, the listener, trying to make sense of aTyr Pharma right now?
Yeah, synthesizing all this, aTyr Pharma is really at a classic high-stakes biotech inflection point. It's almost a perfect case study. The outcome feels very binary, and you see that reflected in the polarized market sentiment we discussed. The bull case is genuinely compelling. You've got this potentially transformative drug, Efzofitimod, targeting a huge unmet need, that 70-plus-year gap in sarcoidosis treatment. The science is novel, first in class. There's a massive imminent catalyst with the Q3 data. You have strong validation from sophisticated institutions and recent insider buying, and they have the cash to see it through the next year. It's a powerful story. But the bear case is equally straightforward and, frankly, terrifyingly simple. It hinges almost entirely on that binary clinical risk. Phase 3 failure would be devastating. They have single asset dependency. There's that huge short interest showing significant skepticism. And even if they succeed, they face hurdles in commercialization and competition.
And as we discussed, traditional valuation just doesn't work here. It comes down to that risk-adjusted DCF model, which points to potentially much higher value if everything goes right, based on those analyst projections of $500 million plus sales by 2029. But that's a huge if.
Exactly. As of today, July 28, 2025, that $5.83 share price really reflects the market trying to balance that massive potential upside against the very real, very significant risk of clinical failure. You can't really call it fundamentally undervalued or overvalued in the traditional sense. It's more like a speculative financial instrument right now. Its price represents the market's best guess, the weighted average probability of two starkly different futures. An investment here today is undeniably a high-risk, high-reward proposition. It's a bet entirely dependent on the outcome of a single imminent scientific experiment.
Wow. That was a truly deep dive into aTyr Pharma. Hopefully that gives you a shortcut to being well-informed on what is definitely a high-stakes biotech story. What's the one thing that really stands out to you from all this?
For me, as we wait for this Q3 data, it's thinking about the broader implications. Beyond just aTyr's stock price, how could this trial potentially shape the future of treating rare inflammatory diseases? What does it teach us about the incredible risks, but also the incredible potential rewards of pushing the boundaries of medical innovation? It's fascinating.
Great point. If you want more insights like this, breaking down complex companies, be sure to like this video and subscribe to the Stock Analytics AI YouTube channel. And remember, members get perks. You can suggest stocks for future deep dives in the comments, and we'll prioritize them. For just $4.99 a month, members get priority access, We're planning to cover all of the S&P 500 stocks over the next few months, and members get first dibs. If you just want a one-off deep dive on a specific company you're interested in, drop us a super thanks.
And just a quick but really important reminder, this analysis was generated by an AI system. It's meant for educational purposes only and should absolutely not be taken as financial advice. Please always do your own thorough research, or even better, talk to a qualified financial advisor before making any investment decisions. Your own critical thinking is key.